Guys, I just saw the news today about Vornado Realty Trust cutting their dividend. So I want to take a little bit of a look at them, but also in the REIT market in general and the ETFs and what they're filled with and what you need to watch out for if you're thinking about buying some REITs now that they are significantly lower than they were just a few years ago. So let's take a look. So the news was that Vornado delayed its dividend and the stock gapped down today about 13%, although it did close practically unchanged. But they say the commercial real estate market faces impending turmoil as office and retail property valuations are anticipated to slide this year due to rising interest rates, which makes it challenging for owners of these properties to refinance the hundreds of billions, if not trillions, in debt coming due over the next several years. So here's a long-term stock chart of Vornado, and you see the price it is at now hasn't been seen since the mid-90s. And so it is off from its high of about $90 around 2015 to $15 now. So here's a chart of Vornado's one-year return versus the Fed funds target rate in blue. So as that goes higher, the one-year returns go lower. And of course, there's a slight lag, but here it goes higher. Here the returns are lower. Here it's lower, then the returns are higher. And so with these higher rates, it is doing a lot worse. Now, although they delayed their dividends, they did authorize a $200 million stock buyback. So for a REIT with about a $3 billion market cap, that's about buying back about 7% of the total stock out there. And so some analysts downgraded it. Piper Sandler saying, if cash preservation is so critical, why are they doing a buyback program? Morgan Stanley is saying dividend-focused investors would be disappointed in the near term, but the share repurchases, if fully utilized, may be accretive to earnings. And Bloomberg here is saying Vornado suspending a quarterly dividend could save around $230 million over the next 3 quarters, which it might use to buy back shares under the new $200 million authorization. So the problem Vornado and other office REITs are facing are the higher financing costs with higher interest rates, coupled with the surge in remote and hybrid work, which has notably impacted offices with rising vacancies. So Vornado CEO says, we are now approaching the eye of the economic storm, and I expect it will get even worse. Not exactly reassuring. And you got hedge fund manager Kyle Bass saying office buildings in big cities need to be demolished because pre-pandemic demand is never returning. And so he insisted towers must be converted into apartments. So because of these problems with office real estate, the CMBX, the commercial mortgage backed index, where you can get long or short the index, the series number 15, which has the highest percentage of office space at 33% and 19% retail, is being said to be the next so-called big short. So with a lot of REITs down so much, aren't they cheap right now? Well, not necessarily, because there's a considerable maturity wall in the commercial real estate sector with $400 billion of debt due this year. And Morgan Stanley says $2.5 trillion in commercial real estate debt comes due over the next 5 years. So here they have a chart of the maturing loans by lender type. 2023 is about $450 billion, and it just goes up from there for the next 5 years. So that's about $2.5 trillion. And you see the other big problem is that banks, mostly smaller regional banks, make up the bulk of these loans that are going to mature, that need to be refinanced at higher interest rates with lower occupancy. So the value of these properties are going to be a lot lower, and a lot of companies may walk away from them. So they say the collapse in the share price of Vornado is what's likely to come for the commercial real estate space. Now, I always think it's better to buy something when it's cheaper than when it's more expensive. So is now the time maybe to buy some REIT ETFs like the iShares Real Estate ETF IYR? Let's take a look. This is by BlackRock. It has an expense ratio of 0.39%. Its 1-year returns are like minus 19%. 3-year returns 9.5, 10 years 5.5. It has a 30-day SEC yield of 2.98%. Now, this is not a dividend. This is funds from operations, which it is taxed as regular income, not as dividend income. So if you do buy one of these, buy it in something like an IRA, a Roth IRA, a 401k if possible. Here's one thing I don't like about this ETF. It will tell you all this thing about ESG, quality score, weighted average carbon, ESG coverage, all this stuff that I don't care about. Weighted average carbon intensity, 99 point whatever, right? But it will also tell you about controversial weapons, nuclear weapons, civilian firearms, tobacco, blah, blah, blah. But if you want to see what the breakdown of percentage of office real estate, retail real estate, residential real estate, it doesn't tell you that. It just tells you what's in it and the weighted percentage. You have to figure that out all on your own, right? So here it says sector, and it just says other, 93.7%. Mortgage REITs, 2.27, diversified REITs. It doesn't tell you how it breaks down, which is something you really want to know if you know that office and retail are doing really bad, right? Now, you can look at the Vanguard REIT VNQ, which is almost the same as the IYR ETF, although it does have a lower expense ratio, 0.12 versus 0.39, right? It also lost about 20% in 1 year. And if you try to look at the SEC yield, there's a note here. And basically, like I said, it's not dividend income, it's something different, which is completely taxable as regular income. So the unadjusted effective yield is 3.8%, which is based on the full amount of REIT distributions, dividend income, as well as return of capital and capital gains. And the adjusted effective yield is 2.48%. And so its return since inception in 2004, almost 20 years, is 7.43, not bad. 10 years, 5.7. And it holds 165 different REITs in it. So kudos to Vanguard for showing the different percentages of the different sectors of REITs that it has. And so if you are worried about office REITs or retail REITs, you can see that retail REITs is 12.7%. And office REITs are only 4.5%. So actually, if you're worried about office REITs and you still want to buy a REIT, this is not a bad one to buy because your exposure to office REITs is not that high. So I don't know the exact breakdown of what's in the IYR ETF, but looking at the chart, it is very similar to the performance of the Vanguard VNQ. So the high was 116, now it's like 85. Vanguard VNQ, high was 116, now it's like 82. So almost very similar. So I imagine it has a very similar composition to VNQ, which has a lower expense ratio. So is most of the bad news for REITs like Vornado already out there and maybe it's a good time to buy the stock? I don't know. Although the stock did gap down today, it closed basically flat. So maybe some people think all the bad news is out there already. However, you have to remember that they still have buildings that are going to be coming up for refinancing at higher interest rates while still struggling to fill these office buildings in New York City and other places. Those two together puts the valuations of those buildings a lot lower than maybe where they were a year or two ago. So maybe you can spread your bets and just buy the Vanguard VNQ ETF and have a general exposure to all real estate, or you can wait to see if this thing gets worse, or you can go and pick out specific REITs in specific sectors that you like, maybe in residential versus office or retail. Either way, be aware of what's in these ETFs you buy because it's kind of like sausage. They don't tell you how much filler of bad things they put in there a lot of times. You have to kind of look for it. So if you want to avoid that, you have to take the time and do the research to pick out individual REITs, which maybe not a lot of people want to do. So it's kind of a trade-off. If you don't have a huge amount of money to put into individual REITs, then the REIT ETF may be a good way to go. Hope you like this one, guys. I'll see you in the next one. Thanks for watching.